I want you to take a deep breath. Seriously, stop looking at your brokerage account for a second and look at me. What you are witnessing right now, what we have all lived through in the last 24 hours, is going to be written about in history books. We just watched the single most violent financial event in the precious metals market since Silver Thursday in 1980. In a span of less than 24 hours, the price of silver, the asset that we have been tracking, stacking, and fighting for, collapsed. It didn't just dip, it didn't just correct, it fell off a cliff. We went from an all-time high of $122 per ounce down to $80 per ounce before the market even opened in New York. That is a 26% crash in a single trading session. Billions of dollars in paper wealth were erased overnight. If you are holding mining stocks, you're probably down 40% or 50% today. If you are holding call options, they probably went to zero. I know what you are feeling right now. I feel it too. You feel sick. You feel cheated. You feel like maybe you were wrong. You're asking yourself, is the bull market over? Was the silver squeeze just a scam? Did I just lose everything? It's easy to panic when you see red candles that big. It's natural to want to hit the sell button and just walk away to stop the pain. But before you do that, before you let them shake you out of your position, I need you to see something that the mainstream media is not showing you. While you are panic selling in America, China just did something unprecedented. Yesterday, right as the price began to free fall, regulators in Beijing stepped in and pulled the plug. They suspended trading on the major silver funds in Shanghai. Think about that for a second. Let it sink in. The price is crashing in London. The price is crashing in New York. The algorithms are screaming, sell, sell, sell. But in China, you aren't allowed to sell. Why would they do that? Why would a government freeze a market that is supposedly crashing? Because my sources on the ground, and the data coming out of the Shanghai Gold Exchange this morning, confirm something terrifying. While the paper price on your screen is crashing, the physical metal in their vaults has hit zero. They didn't freeze the market to save you money. They froze the market because there is no silver left to deliver. In this video, we are going to do a forensic autopsy of the February 2nd crash. We are going to expose the Kevin Warsh signal that triggered the algorithm. We are going to look at the Shanghai arbitrage that proves this price is fake. And I'm going to show you why $80 silver might be the biggest bear trap in financial history. Welcome to the most important update I have ever filmed. To understand the crime, we first have to identify the weapon. This crash didn't happen because solar panel demand disappeared overnight. It didn't happen because Tesla stopped making cars. The fundamentals of silver are exactly the same today as they were when price was $122. So what changed? The Federal Reserve. On Friday afternoon, just as the markets were closing for the weekend, President Trump dropped a bombshell. He officially nominated Kevin Warsh to be the next chairman of the Federal Reserve. Now, if you are a casual investor, you might not know that name. But Wall Street algorithms know that name very, very well. And the moment that news hit the wire, the computers were programmed to execute one specific trade. Kill gold, kill silver. Why? You have to understand who Kevin Warsh is. He is not Jerome Powell. He is not Janet Yellen. Jerome Powell was a politician. He tried to please everyone. He printed money when the market cried. He kept rates lower than he should have to keep the soft landing narrative alive. Kevin Warsh is different. He is a hard money hawk. He is a protege of the old guard who believes that the stability of the US dollar is the only thing that matters. For years, Warsh has criticized the Fed's balance sheet. He has argued that the Fed prints too much money. He has argued that inflation is a tax on the poor. So when the market sees Kevin Warsh is the new Fed chair, here's the instant calculation the AI trading bots make. Warsh hates inflation. Therefore, Warsh will keep interest rates higher for longer. Higher rates make the US dollar stronger. A stronger dollar crushes commodity prices. It's a simple if this, then that logic chain. The moment the nomination was confirmed, the dollar index, DXY, spiked. And since silver is priced in dollars, the algorithms dumped it. They dumped $4 trillion worth of paper contracts in a liquidation cascade. This wasn't a human decision. This wasn't a miner deciding to sell his inventory. This was a mathematical reaction to a political appointment. But here is the irony. Here is the joke that the algorithms missed. President Trump nominated Warsh because he thinks Warsh will lower rates. Trump wants cheap money. He wants a booming stock market, but Warsh has a history of independence. So we have a conflict brewing. The president wants to print money. The Fed chair wants to stop printing money. This creates chaos. And do you know what silver loves more than anything? Chaos. The algorithms sold because they think Warsh will save the dollar. But the reality is, by the time Warsh actually takes office, the damage to the supply chain will already be done. They used a news headline to smash the price. And that gave the smart money the liquidity they needed to do the one thing they have been desperate to do for months, cover their shorts. Now let's move away from the political theater in Washington and look at the actual crime scene. Let's go to Shanghai. While American investors were panicking over Kevin Warsh, something very strange happened on the other side of the world. China controls 70% of the refined silver supply. We know this. We talked about the January 1st export ban in my last video. But yesterday, as the global price began to crash, the Shanghai Gold Exchange, SGE, and the managers of China's largest silver futures funds issued a trading halt. Now, in the stock market, a trading halt usually happens to protect investors from volatility. It's like a timeout when things get too crazy. But in the commodities market, a halt like this usually signals a broken mechanism. According to reports from FX leaders and sources within the Asian markets, the halt wasn't just about price volatility. It was about liquidity. The funds were facing a massive wave of redemption requests. People saw the price dropping and wanted their cash out. But here's the problem. These funds are supposed to be backed by physical metal. If I give you $1 million to buy silver and then I ask for my money back, you have two choices. You give me the cash, you sell the silver to get the cash. But what happens if you don't have the silver? What happens if you took my money, leased the silver out to a solar panel factory, and now the vault is empty? You can't sell what you don't have. So instead of admitting we are insolvent, they simply turned off the buy-sell button. They locked the investors in. This is a Hotel California moment for the Chinese silver market. You can check out anytime you like, but you can never leave. This is why we stack physical, because when the system breaks, paper silver becomes a frozen screen. Physical silver remains wealth. But the halt tells us something else. It tells us that the inventory levels in China are critical. If there was plenty of silver, they would have just let the market trade. They would have let the price crash, bought the dip, and moved on. The fact that they had to intervene suggests that they are terrified of a run on the vaults. They know that if the price drops too low, industrial buyers, the Samsungs, the Teslas, the BYDs, will swoop in and buy every remaining ounce at a discount. So they froze the price to stop the bleeding. They are protecting the physical inventory at the expense of the paper price. They want you to believe the price is $80. But math does not lie. Right now, as I record this, the spot price in New York is roughly $80. But if you try to buy a physical kilogram bar in Shanghai, assuming you can find one, the implied price is roughly $115 USD. That is a $35 spread. In a normal functioning market, this is impossible. If silver is $80 in New York and $115 in China, a trader would simply buy it in New York, fly it to China, sell it, and make a risk-free profit. This is called arbitrage. When arbitrage happens, the prices eventually meet in the middle. But the gap isn't closing, it's getting wider. Why? Because you cannot get the silver out of New York, and you cannot get the silver into China fast enough. The Jan 1st export ban broke the bridge between the East and the West, so we now have two markets. The Western paper market, driven by Fed rumors, algorithms, and fear. Price low. The Eastern physical market, driven by factories, shortages, and industrial demand. Price high. Which price is real? Ask yourself this. If you go to a car dealership and the sticker says $20,000, but the dealer says, sorry, we have no cars for sale, is the price really $20,000? No, the price is irrelevant because there is no product. The $80 price you see on your screen is the no-car price. It is the price of a paper contract that claims to own silver. But if you actually try to stand for delivery, if you try to exchange that contract for metal, good luck. I called 3 major bullion dealers in the US this morning. Dealer number 1, sold out of Silver Eagles. Dealer number 2, 3-week delay on shipping. Dealer number 3, we have raised our premiums to $15 over spot. So the spot price crashed, but the price to buy a real coin actually went youpie for some people. That is the definition of a broken market. That is the definition of a divergence. And historically, whenever paper and physical diverge this much, the paper price always snaps back up to meet the physical price. It never happens the other way around. We have to zoom out. We have to remember why we are here in the first place. This volatility is noise. The signal is the industrial crunch. Remember the video I made about the January 1st regulation? Link in the description if you missed it. China didn't just ban exports for fun. They banned exports because they are running out of silver for their own solar panels. Solar panel production is set to double in 2026. The new solid-state battery technology for EVs uses 3x more silver than the old batteries. AI data centers, which are popping up everywhere, require massive amounts of silver for their high-end connectors. Kevin Warsh getting nominated doesn't change physics. A higher interest rate doesn't make a solar panel work without silver. A stronger dollar doesn't magically create new silver mines. The deficit is real. We are consuming 1.2 billion ounces a year, and we are mining less than 850 million ounces. That is a math problem that cannot be solved by a Fed meeting. What we are seeing today is the paper market throwing a tantrum, but the industrial market is still hungry. The factories in Shenzhen don't care about the Fed chair. They care about keeping the lights on. And right now they are draining the vaults. My prediction? This crash to $80 is the final gift. It is a liquidation event designed to flush out the leverage. The banks are covering their shorts, the weak hands are selling their coins, and once the dust settles, maybe in a week, maybe in a month, the reality of the shortage is going to hit the market like a freight train. When the factories realize they can't get metal at $80, they will bid $90, then $100, than $120. And the paper market will be forced to chase the physical reality. So what do? You just watched your portfolio drop 26%. You are bleeding. I am not a financial advisor. I am just a guy reading the data. But here is what I am doing. 1, I am not selling. Selling now is giving your wealth away to the very people who rigged this crash. You are selling at the bottom of a panic. That is rule number 1 of what not to do. 2, I am watching the Shanghai inventory levels. I don't care about the COMEX price anymore. It's noise. I am watching the daily withdrawal reports from the Shanghai Gold Exchange. As long as those vaults are emptying, the squeeze is on. I will be posting those updates on this channel every morning. 3, I am buying the fear. I am heading to my local coin shop today. I'm going to see if I can find any physical metal near this $80 spot price. If I can get silver for under $90 today, I consider that a steal. Because I know that in 6 months, we will look back at this Warsh crash as the last great buying opportunity of the decade. This is psychological warfare. They want you scared. They want you hopeless. They want you to look at that red chart and think it's over. But ask yourself, why did China freeze the market? Why are the vaults empty? Why are premiums rising? Because it's not over. It's just getting started. Do not let them take your silver. If you want to track the Shanghai inventories with me, make sure you are subscribed, stay strong, stay solvent, and I will see you in the next one.